So I'm excited to share with you something that a lot of people have been waiting on for a long time, for almost 3 years, if you will. So you have to understand in 2022, they began raising interest rates. And 13 years prior to that, rates never went over 5.25%. But you have to understand that in 2022, March of 2022, they began raising interest rates. And by October, they were literally over 7.5%. So the rates doubled. What happened was a freeze in the housing market. People really couldn't afford homes. And for me personally, I've always said they left the rates too low for too long. And they blamed that on COVID. They blamed that on the housing recession. And they kept the rates really low. But you also have to understand that for 21 years, mortgage interest rates never went over 7%. That's pretty hard to believe. I've been in this business for 30 years. So as they raised the rates and they got to right at 8%, it froze the housing market. As a result, people are not buying houses. I mean, 2024, for example, was the slowest year for home sales in the previous individual 29 years. It was the slowest year. And in 2025, the number of home sales is slower than 2024. As a result, they are going to make an adjustment in the mortgage rates. And the reason being is because the unemployment rate is a little bit higher. And that's what they've been waiting on is the unemployment rate. And they also look at the CPI, Consumer Price Index, to see, okay, how is inflation? It did dip pretty good. It got around 2% around April, and then it's kicked back up a little bit. They're saying that's temporary. And they're looking at the housing. They're looking at the job report. They're looking at the, all these factors, which are going to make the rate lower, but they're not going to do it really quick. They're not going to make a huge drastic drop, which is a good thing because you have to understand it's all of our money. It's a buy. We're all going to be a buyer, all going to be a seller, right? And the cost of that money, you want to keep it balanced out. For example, you have all these people that did not purchase a house, and if you were to lower the rates drastically, like a half a basis point, and that rate were to adjust where interest rates all of a sudden are 5.5% on a 30-year fixed mortgage, you would have so many people flock into the market. And when you do that, it's going to cause a rise in inflation. Why? Because so many people are buying. And then it's based on supply and demand. So everything is based on the demand of which somebody wants a good or service, and that's supply. And right now, we have a less supply of houses. We have a shortage of homes. And it's been that way for about 10 years. So we've had a shortage of buyers and a shortage of housing. And now all of a sudden, if you get this rapid influx of buyers with the shortage still, then what you're going to have is you're going to really see prices go up. And that's something that we don't want to see. If we just lower the rates a little bit, you're going to see people are going to be, well, hey, let's buy. Maybe now's the time to get out, look at those houses, buy a home, buy another vehicle, whatever it may be that you're financing a big ticket item. But some people may sit and go, you know what? If Wayne's saying that the rates may drop again, then let me hold off. The point I'm trying to make is you have to understand this. There's a lot of people that are pretty much trapped, set, locked in their home. Maybe you're one of them. Comment, please, if you are or know someone who is. And that means that you have a rate of interest rate of anywhere from 2.5, 2.9 to 5%, 4.5%. The good news is you're gaining equity because you're paying down your mortgage, you're paying less in interest, and it's going up in value. The flip side of that is a lot of people that I've talked to are like, Wayne, I can't afford to move out of my home. I can't afford if I sold my house for $400,000 and then took $100,000 in equity and then bought a $500,000 home because the rate at 6.5% on a $400,000 mortgage is going to run you $3,600 a month, depending on where you live. If you live in a state that has extremely high property taxes, that mortgage payment can be in excess of $4,000 a month. So what this means for homeowners and just everybody really is when the money gets less expensive, it gives you more opportunity to sell your house. It gives you more opportunity to sell and retire, to downsize, to upsize, whatever it may be. Right now we see a lot of people that are selling their house because they're going through a divorce, or they got a job transfer, or it's an estate sale, or they're a first-time home buyer. However, first-time home buyers are down in the 35, 34% range, which is the lowest it's been in years. But here's an opportunity that a lot of people don't realize, and I think it's important for everyone to understand this. When you have equity in your house and you have debt, if you're going to make a move, a lateral move, for example, because the rates have dropped, they're a little bit lower, You have to understand that you can take the equity in your home and actually pay off your debt. See, a lot of people don't like debt. I get it. A lot of people get credit card debt, student loans. It doesn't matter what it is. Car loans, we all get it. We all been there. But here's a way that which you could sell your house and make a lateral move and be debt free when you do that. You don't have to make a lateral move. You can downsize, you can upsize, you can retire, buy that condo at the beach, whatever it may be. The point I'm trying to make is when you have equity in your home, say $100,000 equity in your home, you got $50,000, $60,000 in debt. You're like, man, I got debt payments, I got my mortgage payment. You have to look at what your mortgage payment's going to be. They're going to drop the rates. And when they drop the rates, you're probably going to be looking at a 5.9% rate on a 30-year fixed loan. And if they drop the rates to that, you got to look at what your payment's going to be. And then you also have to add up what are your total payments on credit cards, student loans, the boat, the four-wheeler, the car, whatever it may be. And then you have to look at the total balance of those items and then the total equity that you have in your home. And you have to look at and consider, what if I took some or all of my equity and paid off all my debt and then went and purchased another home? Now, how you do that is if you're a veteran, you can do a veteran loan. The veteran administration doesn't cost you any money out of pocket. Seller pays your closing costs. You can do USDA type loans, depend on your income, lots of variables. The point I'm trying to make is really simple. You have equity in your house. You can pay off your debt, and you don't have to do that by getting a second mortgage or a home equity line of credit. You simply contact a lender, and if you need help with that, you can go to contactwayne.com. We have lenders and agents all around the country in every city, every state, every county, every parish. It doesn't matter. We're glad to help you. Most importantly, you can take that equity and pay off your debts, and it's done at closing. So when you contact a lender and say, hey, this is everything that I have. I'm an open book. Here's everything that I owe, and I want to buy a house. How much can I qualify for? And there's a difference between being qualified, being approved, being pre-approved. First of all, there's no pre-approved. You're just approved. You get approved. It has nothing to do with the house. You just tell them you want to be approved. They're going to verify your income, taxes, how much money you have in the bank, how much equity you have in your house, so you can sell your home and have equity left over to pay off all of that. And it's done at closing. You see, you literally can put your home on the market, you go find another house, you get a contract on your home, and you close on your new home the same day. You walk into an attorney's office, title company, attorney, depending on your state. They will take your equity based on what's instructed with the lender from the conversation that you've had with that lender, and they will pay off your equity. They take money proceeds from your sale, and they will mail it to those creditors. You're left with zero balance. You give the keys from your house, your old house, to the new buyer, and then you take the keys and get the keys to the house that you're buying. It's simply a closing of one folder and opening up another one. And I just want to explain that to people, not to talk into anything, but I just want you to know so you can make the best informed decision when you're watching these videos when it comes to real estate, housing, and just home affordability, so you can understand the opportunity. Now, let's jump over to being a first-time home buyer. Now, if you're a first-time home buyer, maybe you're on the fence. A lot of people say, well, Wayne, I don't want to buy a house. I just want to rent. Or why would you buy? The rates are high. The homes are not affordable. Listen, I can tell you with 100% certainty, there's not going to be a housing crash. There's not enough homes on the market to have a housing crash. We've seen a shortage literally for the last 10, 12 years. We've been behind that, if you will, and then now people haven't been purchasing homes. There's still a shortage. But if you're a first-time home buyer, you have to consider this. If you paid $1,500 a month in rent, and you did that for a year, that's $18,000. And that $18,000 over 10 years is $180,000. What do you have? We all have to have food, shelter, clothing, water, right? I get it, to survive. But when you rent, you're paying 100%. You're not getting anything but the service that provides for you, called shelter. And so there's nothing wrong with that, if whatever makes you happy. But what I find is when you become a little bit mature in life, you meet someone that you really love, you buy a house, you start a family, you're raising kids, you want that stability. It's good for children. Speaking from somebody that moved a lot when I was a kid, it was really nice once we got stable as a young man, a child. It was fun for me. And you're probably thinking or experiencing the same thing. If so, give me a thumbs up, leave a comment. We all learn from one another. The point I'm making is something to chew on. You're paying 100%. You're paying 100%. So I'll give you a prime example. I bought my first home. I paid $79,500 for the home. 5 years later, I sold the house for $105,000. I made $25,000. And I took the $25,000 and I divided that by 60 payments because that was the 5 years. And I was paying $720 a month on that mortgage. But the money that I got back was over $300 a month when you divided it out. So it's like, wow, I actually bought a house. I was paying $720 a month. But in all actuality, I was paying $340 a month. I just got it in arrears when I closed on the house. And it allowed me to take that equity and move up in life and buy a bigger house. So listen, at the end of the day, I'm not trying to talk you into anything. I'm just giving you as much information based on my 30 years of life experience, not just in life, but in real estate, selling, brokering homes, been around the lending business, bought, flipped, built, done just about everything. And my goal is to share something with you that you can take with you so you can learn and make the best informed decision when it comes to your real estate transaction. Hope you enjoyed the video. Give me a thumbs up, like it, share it. Until next time, God bless you.